For 6 years in a row, Fortune magazine named this company America's most innovative company. At its peak, its stock traded above $90 a share, and it was the 7th largest corporation in the United States, employing over 20,000 people. 3 months later, that stock was worth less than $1, and the company had filed what was, at the time, the largest bankruptcy in American history. The innovation Fortune kept praising wasn't a product. It was a way of counting money that let the company report massive profits it had never actually earned. This is the story of Enron and how one accounting decision turned an energy company into the biggest corporate fraud America had ever seen. To understand how Enron collapsed, you first have to understand what the company actually did and how ordinary that business originally was. Enron was formed in 1985 when Houston Natural Gas merged with a company called InterNorth, creating one of the largest natural gas pipeline networks in the country. Under CEO Kenneth Lay, the business was, at first, exactly what it sounded like: a pipeline company that transported and sold natural gas. But through the 1990s, Enron's ambitions expanded far beyond pipelines. The company began trading energy contracts the way a Wall Street firm trades stocks, buying and selling not just gas itself, but complex financial contracts betting on its future price. This shift, led by an executive named Jeffrey Skilling, would transform Enron from an energy company into something closer to a financial trading firm that happened to own pipelines. And it required a very different way of counting money. Jeffrey Skilling's central innovation was convincing regulators to let Enron use something called mark-to-market accounting. Under this method, when Enron signed a long-term energy contract, it didn't have to wait years to record the profit as the deal actually paid out. It could immediately book the entire projected value of that contract as profit today, based on its own internal estimate of what the deal would eventually be worth. For a trading company, this was an enormous advantage. It meant Enron's reported earnings could grow explosively based on projected future deals, not just money that had actually arrived. Wall Street loved it. Enron's stock climbed steadily through the late 1990s, and the company expanded aggressively into broadband, into water utilities, into international power plants, and eventually into trading almost anything with a price attached, including weather derivatives. By 2000, Enron's stock had crossed $90 a share, and the company reported revenues of over $100 billion, making it the 7th largest company in America by that measure. Kenneth Lay and Jeffrey Skilling were celebrated as visionaries, reinventing an entire industry. Fortune named Enron America's most innovative company 6 years running. But mark-to-market accounting had a serious problem hiding underneath the growth. When a projected deal turned out to be worth less than Enron had estimated, or lost money outright, the company still had that inflated profit sitting on its books. And by the late 1990s, a growing number of Enron's ventures, particularly its broadband and international investments, were quietly losing enormous amounts of money. Enron needed a way to keep those losses off its balance sheet entirely. Chief Financial Officer Andrew Fastow built exactly that. Fastow created and ran a web of off-the-books entities, special-purpose vehicles with names like LJM and Chuco, that existed largely to buy Enron's underperforming assets and absorb its bad debt, keeping billions of dollars in losses out of Enron's official financial statements. On paper, these entities were legally separate from Enron. In reality, they were financed and controlled largely through Enron's own stock and Fastow's own involvement, sometimes generating him tens of millions of dollars personally in the process. This structure let Enron keep reporting steadily rising profits year after year, even as significant parts of the actual underlying business were failing. Wall Street analysts and even Enron's own board largely didn't grasp the scale of what was happening. buried inside footnotes and Byzantine financial structures that few outsiders had the access or the incentive to unravel. Here's the irony sitting underneath the whole company. The exact same aggressive, innovation-at-all-costs culture that had won Enron 6 straight Most Innovative Company awards, the willingness to invent new financial structures nobody else in the industry was using, was the very culture that let a handful of executives hide catastrophic losses using structures almost nobody inside the company fully understood until it was too late to unwind them quietly. Cracks began appearing publicly in mid-2001. Enron's stock had already been sliding for months when, in August 2001, CEO Jeffrey Skilling abruptly resigned after only 6 months in the role, citing personal reasons, a move that unsettled investors and analysts already uneasy about the company's complexity. Then, in October 2001, Enron reported a massive unexpected loss and disclosed a significant reduction to shareholder equity tied directly to Fastow's off-book partnerships. The Securities and Exchange Commission opened a formal investigation shortly after. As details emerged about the scale of hidden debt and the conflicts of interest in Fastow's arrangements, investor confidence evaporated almost overnight. The stock, which had traded above $90 a year earlier, collapsed toward pennies within weeks. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. At the time, the largest corporate bankruptcy in U.S. history. Roughly 20,000 employees lost their jobs, and many lost the bulk of their retirement savings, which had been heavily invested in Enron stock through the company's own retirement plan, even as executives were privately selling their shares. The fallout extended well beyond Enron itself. Arthur Andersen, one of the 5 largest accounting firms in the world and Enron's auditor, was convicted of obstruction of justice for destroying Enron-related documents, a ruling that effectively destroyed the firm and put thousands of unrelated employees out of work, even though the conviction was later overturned on a technicality. By then, the firm no longer existed. The scandal also became the direct catalyst for the Sarbanes Oxley Act of 2002, a sweeping new set of corporate accounting and disclosure regulations still in effect today. Kenneth Lay and Jeffrey Skilling were both convicted on multiple counts of fraud and conspiracy in 2006. Lay died of a heart attack just weeks after his conviction, before he could be sentenced. Skilling was sentenced to 24 years in prison, later reduced on appeal, and was released in 2019 after serving roughly 12 years. Andrew Fastow pleaded guilty and cooperated with prosecutors, receiving a reduced sentence of 6 years, and has since spoken publicly at business schools and conferences about the ethical lessons of what he built. Enron itself no longer exists in any form. Its remaining assets were sold off during bankruptcy proceedings, and the name today functions mainly as shorthand in business schools for corporate accounting fraud. Enron's story isn't really about energy trading. It's about what happens when an accounting method designed to reflect future value becomes a tool for reporting profits that were never real, and how a culture built entirely around looking innovative can end up hiding the fact that the underlying business has already failed. It's a pattern that shows up again and again in business history. The exact mechanism that wins the awards and impresses Wall Street is often the same mechanism nobody thinks to question until the money runs out and there's nothing left to hide it with. If you'd like to understand the hidden forces shaping our global economy, help us by subscribing to our channel.